Lagos Traffic Radio 96.1 FM. Anytime you hear this tune, of course, it's time to branch to the world of insurance and discuss all things possible that will make things much brighter and much more beautiful for you. You're welcome to Insurance on the Move, and it comes to you every Thursdays from 6:30 through 7 o'clock. It is an initiative of ICO Insurance to educate as much as possible all of you who are listeners, and then that will make you tap into insurance and make good use of it. You're welcome. My name is Victor Oteri. All right, then. So today we're going to be continuing the dialogue on that vital aspect where we started last week. It's all about you knowing the principles that guide the practice of insurance. There's so many things that happen out there, and some of you will be wondering, how does insurance really work? All right, so insurance has a set of principles that govern its activities, and if you do not understand it, you might just be wasting your time. So my guest in the studios, the network playing pranks on us last week, so he has decided to be here, and then we'll be able to take you through that during the course of the program. Loads and loads of traffic updates as well will be served hot and fresh. But right now, let's delve to the... okay, let's just have a word from our partners. And of course, when we return, we kick off with some updates, and then we'll jump in on the topic for this evening.
Wow! What just happened? What kind of question is that? Can't you see? Wow! That looks like a brand new SUV. What vehicle is that? What kind of question is that? Can't you see? Was it the motorcycle that caused it? Or the cooling van? What kind of question is that? Can't you see? But why is that man smiling and pressing his phone instead of pressing that careless man's face against the car's floorboard? And what kind of question is that? Can't you see? But what kind of man is that?
Kwetu, seriously, what kind of man is that? Yes, that's the kind of man that has prepared for the unexpected. The man that knows that when accident happens, ICO Auto Insurance Plan keeps you covered, so you don't have to worry. Get the ICO Auto Insurance Plan today. Call us on 0700 iContact, that is 0700 2442 668228, or visit www.icoplc.com to learn more. ICO Insurance, your stable friend. Yesterday, today, and always.
Your stable friend, yesterday, today, and always.
Lagos Traffic Radio 96.1 FM. Insurance on the Move is the program we set for the conversation this beautiful evening. It's a return trip, and of course the travel advice for you this evening is still looking good. Well, if you look at the major connecting points, especially on the Third Mainland Bridge, the bridge itself is looking very good to go at this time. But of course, things begin to slow down by the time you approach Ifako, connecting Ogudu. Ifako was slow earlier on, but it's getting much better. That's from the feeds that we're getting in the studios right now from our live cameras. Ifako getting better. Ogudu heading towards Alakpere. Yeah, you might have it slow there as well. And nothing unusual, high influx. Pedestrian crossings might be responsible for that one as well. All right, then, so we'll be serving you more L-Pains as they come in. But right now, let's focus on the conversation this evening. And last week, we started that conversation by looking at basic insurance principles, why insurers do what they do. Now, there are rules and principles guiding the practice of every profession, and in insurance, it's not any way different. Now, understanding these basic principles is the key to understanding how insurance works. Now, these principles are not just for the Nigerian insurance industry. They are global in their application. So, Today, we're going to be trying in our own little way to educate the insuring public on what these principles are so that they can be better informed on why insurance companies do certain things that they do out there. You know, sometimes you just be wondering, why? I did this, I paid this, and after all, this is what they told me. Now, this conversation is coming against the backdrop that, we have some people out there that are saying insurance companies would collect your premium, and when there is claim, they will just turn a blind eye. They will begin to tell you some Mongo Park stories hiding behind those small prints in their policy. But that's not true. We heard people on this program that have been able to attest to the fact that, insurance works. So that's why some of them do say, yes, there's dependability that comes with you having to pick up an insurance policy. And that is why we'll be reflecting on this so that you can understand all of this to meet your financial obligations. And joining me in the studio this evening, I'm so happy to bring him to the microphone, Shedrack Adegoke. He's a non-life underwriter with ICO Insurance, and he's here with me live. Nice to have you. Good evening.
Good evening, Mr. Victor.
And how are you doing?
Very well, thank you.
It's your first time in how many years? 5, 6, 7 years of being in the studios.
Yeah, that's true.
Right, so look to your left, you can see our live cameras. What do you make of this big screen, by the way, showing Lagos roads?
It's fantastic,
right?
To say the least.
I'm sure you must have been marveled.
Yes, I was.
Wow. So at every point in time, we can see your vehicle. If you want me to zoom it on you, we just pull you out. If you perform anything on the road, we'll call you. That's our Shedrack Adegoke's vehicle. All right, so it's nice to have you in the building.
Yeah, thank you.
So by way, and of course for the benefit of those who are listening to us for the very first time, I would like you to just talk a little bit on what insurance is. Define insurance for us.
All right, thank you very much. Insurance is a legal contract between two parties, the insurance company, or otherwise known as the insurer, and the individual who is picking up the insurance policy. A contract wherein the insurance company will promise to compensate for financial losses due to the insured contingencies in return for the premium paid by the insured individual.
Right.
So there is a contract between the two parties. The insurance company agrees to pay in the event of a claim, and then the insured, in order to secure that agreement, needs to pay a premium.
So more or less, insurance companies is telling people out there, okay, if you have any wahala that is called risk, bring it to my shoulders. I will help you to shoulder it for just a token. And once that thing happens, we will compensate you. Is that what it means?
That's true.
Okay. All right. So how does it work? Because if you're saying, I've heard people say pool. We put some little money together, 10 kobo. Now it becomes a swimming pool of money. So describe it for our listeners. How does it work?
All right. Thank you very much. Now, the concept of insurance works on the basis of pooling of risks. When you buy any type of insurance policy from an insurance company for a specified period with specific cover in mind, you will make regular payments. Those payments are called premium,
okay,
and they are usually annual. In some cases, there might be exceptions where they will give you maybe quarterly or biannually, but the standard is usually annual towards the same policy. So similarly, insurance company collects premium from some other clients with similar risk profile.
Okay.
So they bring all of this money collected together into it. So that's where the concept of pool comes in.
All right.
Collect from A, from B, up to 1,000 people, you put them together in a pool. And when any one of them suffers a loss that is covered by that policy, they take out of the pool of funds to indemnify or restore the person to the position he or she was before the loss occurred.
So with the agreement that not every of these 1,000 persons can suffer a loss at the same time, right?
Of course. So the calculation of premium is based on some underlying conditions.
Right.
One of them is that maybe, okay, in a year, out of 1,000, maybe 100 people we have a claim. Out of the 100 people, for example, if it is motor insurance, maybe 2 or 3 we have a total loss claim, and the other one maybe bumper, that kind of thing. So all of this have been taken into account in determining the premium payable.
Let me just take this out of the ordinary and give you some kind of scenarios before we move on this evening. Shedrack, what in the event, like we're having this hurricane sweeping through 6 states in America, let's bring it to home, to Lagos. In the event that maybe we've taken flood insurance, if there's anything like that here, and 6 states, or let's assume that the whole state of Lagos is engulfed with floods, will insurance be able to take cover for that?
Okay, so at least up until now, we have been lucky, even though there have been a couple of flood cases in some select parts of the country. But up until now, things have been relatively okay. But there are covers we sell that cover flood.
Okay.
So these are some of the things that the underwriter, the insurance company would have taken into account in their own risk management and reinsurance placement. It is possible that you have hundreds of houses flooded at the same time. In that kind of situation, the underwriter or the insurance company will now be subject to an accumulation of risk, not just one.
Okay.
For example, if you are going to pay 10 million for one, you are not talking about 100, so you can have up to 10 million times 100 scenario. So it is a possibility, but all of these are usually taken into account by the insurance company in determining the amount of risk they put in a book, they retain, and then the proportion that is ceded to the reinsurers.
Okay, so in that kind of circumstance, insurance will depend on other insurance companies as well, called
We
reinsurance.
call them reinsurance.
All right. So let's now divert, perhaps let's now focus on the main subject of discourse, which is the principles that guides insurance. Shadrach, talk to me. What are these basic principles?
All right, thank you. So one of them is the principle of utmost good faith, or obremai fidel.
Okay.
Then we have the principle of interest, insurable interest,
All right.
contribution, subrogation, loss minimization, and of course, causa proxima, that is the nearest cause.
Okay. So we have like about 6 or 7 of them? Seven of them.
Yeah.
All right. So let's now begin to consider one after the other of these principles and their benefits. So talk us through it.
All right. So obremai fidel is a contract, a legal agreement common to the insurance industry, requiring the highest standard of good faith during disclosure of all material facts that could influence the decision of the other party. In this case, we are talking about the insurer. Of course, in a contract and an insurance contract, there are two parties, the insured and the insurer. It is the insured bringing a risk to the insurance company for him to cover. So it is assumed that the insured knows everything about the risk he is bringing to the table. So if the insurance company asks question, the principle of utmost good faith
Must come in.
The insurer must be able to provide all the information relating to the questions that the underwriter
So
asks.
it means I am saying the truth and nothing but the truth.
Yes.
You mean it?
Yes.
Nothing must be hidden.
Nothing must be hidden. The reason why this is important is because when the insurance company has obtained all the necessary information in respect of that risk, it is those information that will be used to determine the premium payable. So if the insurer decides to withhold any part of the premium, any part of the information, the insurance company will be deceived, and he may now charge him a premium or rate that is lower than he should have charged if all the information had been provided.
Okay. So that could happen.
Yes, it could. We have seen a couple of cases where it happened.
Yeah, but I'm curious, would that not be unfair if in the event of anything like that, would that not be unfair to the insuring public if an insurance company would now decide that, well, maybe because I was not able to disclose everything that I have, or perhaps I did not tell the true or accurate detail of this insured product, and then I'm going to be paid less, would that not be unfair to me as an insurer, as an insurance person?
No, it will not be unfair to the insured. This is because for an insurance company to decide whether or not they will insure a risk and at what premium, they need to know everything pertaining to that particular risk. And this information can only be acquired if the insurer provides them. He is the one who is bringing the risk, and it is assumed that he knows everything about it.
Right.
And that is why the proposal form is important that I mentioned this. The proposal form is usually designed to elicit as much information as possible in respect of the risk. For example, I bought a car 5 years ago, and the car was insured with insurance company A. And I had series of repair claims within the first 3 years that the loss ratio was as high as 500%.
Right.
That is, I have been paid in claims. The implication of 500% loss ratio is that I have been paid in claims 5 times the amount I have paid as premium on that policy. Now, the insurance company, after the expiration of the policy, the 3rd year, decided to increase my premium at the inception of the 4th year because of the series of claims I had had. However, because I did not want to pay...
Hello.
Okay, I have a call. Hello, good evening.
Yes, good evening.
Okay, who is this?
Yes, it's Sean.
Your name is?
Sean.
Okay, Sean, so we're talking insurance this evening, and we're making reference to some of those principles that guide insurance. So I don't know if it's insurance you want to talk about or you want to talk about the traffic.
Well, the insurance I want to talk about.
Oh.
I just want to ask
Okay, go ahead.
Shadrach in the studio.
Okay, good.
Please, what is reinsurance and how does it work?
Okay, reinsurance,
I'll
right?
be listening. Yeah, reinsurance, yes.
Okay.
And how does it work?
Okay. All right, Sean, where are you calling from?
I'm calling from Agigi.
Agigi, all right then. Sean, thank you so much.
All right, thank you.
All right, so I guess Sean must have picked up from, the question I asked earlier on about other companies having to pull things together if you have a massive flooding situation. So maybe you just want to respond to Sean right away. What is reinsurance?
All right, thank you very much. So as insurance companies, there is a limit to the amount of risk that can be retained in our books. We need to take into our account our shareholders fund and some other things.
Okay.
So when, for example, if an insurance company takes in a risk of 1 billion naira, a building, insures a building of 1 billion naira.
All right.
It is not expected that it will sit on the 1 billion naira with the expectation that if there is a loss of 1 billion naira, is going to cough it out. You may not be able to afford that kind of.
So what will it do?
So what they usually do is to make sure they reinsure. So you can call the reinsurer of the insurance company. I don't know if you get that gist.
So who are those that are reinsurers?
Okay, so
Are they also companies too?
they are insurance companies.
Oh. Okay, is it more or less like we're sharing this risk among other insurance companies?
No, that is different.
Okay.
They provide security or support to the insurance companies.
Oh.
When you talk about risk sharing between insurance companies, that one is I take 10, for example, out of 100%, one company takes 10, one takes 20, one takes 30, one takes 40. But I, as company A, the 10% that I have taken, I need to get reinsurance support for that particular risk. If the sum assured is above the limit of my retention as an insurance company, such that if there is a loss and my share of the claim is 1 billion naira, I, as a company, do not need to cough out the 1 billion naira from my company's purse, so to speak. Maybe I had retained 10% of that 1 billion naira. So that means I will pay 100 million and then recover 900 million from reinsurance companies. So
this is interesting.
We call them insurance companies of insurance companies. They insure insurance companies.
All right, let's get back to the focus this evening. But before we do that, we're going to take a short break. This is Insurance on the Move, and Shadrach Adigoke, a non-live underwriter with ICO, is taking us to the classroom this evening. We're discussing principles that guide the practice of insurance, and we're asking some of those questions. And then we want you to understand reasons why some insurers do what they do. We're going to take a short break right now. When we return, he has talked about reasons, or perhaps he talked about the first one, which is utmost good faith. But there's something called non-disclosure, right?
That's correct.
Non-disclosure. Fraudulent non-disclosure.
That's correct.
All right. So Shadrach will talk us through that. What does it mean? And what other types of non-disclosures do we have? And what implications does it have on the validity or perhaps the authenticity of an insurance contract? These are many more we'll be reflecting on, but a brief break, we'll be back.
What's wrong now? I think my street is jinxed. Over the weekend, my apartment was boggled, and the criminals made away with valuables. They even took my son's toy treasure box. Stable and reliable. And just this morning, there was a huge fire incident in my neighbor's house and he lost everything. I mean everything. Wow. Anyway, like I said before, stable and reliable. What are you saying? Are you mocking me? Abba, of course not. I just said obtainable, portable, blah blah blah. I can rhyme too. It doesn't help my situation. Okay, you remember I had similar experience last year, but thankfully I had signed up to a fire and burglary insurance plan with a stable and reliable partner, ICO Insurance. Oh, now I get it now. Yeah. But why didn't you tell me all this while now?
When the unexpected happens to your home appliances, ICO provides the insurance cover that makes you worry-less. Get the ICO Fire and Burglary Insurance Plan today. Call us on 0700 iContact. That is 0700 2442 668228 or visit www.icoplc.com to learn more. ICO Insurance, your stable friend. Yesterday, today, and always.
Lagos Traffic Radio 96.1 FM. Traffic Radio 96.1 FM. Insurance on the Move is the program, and Shedrack Adegoke is our guest this beautiful evening. We're talking principles guiding the practice of insurance. Why do insurers do what they do? Alongside Ikeja, very good movement all through. Mobolaji Johnson is looking pretty good this evening. Awolowo Road from Barracks up to Allen intersection is busy. This is due to high influx and alternation at Allen. We can tell you it's good traffic from Allen connecting Ikeja. Little delays at Olowu due to massive turning at Ikbudu Junction, but nothing to worry. We can tell you that the return journey from Ikeja underneath the bridge up to Allen looks pretty good. Likewise, from Radio up to Alausa, very much in good shape as well. We've given you more helpings, but let's get back to the program. You have been discussing that first principle, utmost good faith, and there's this aspect of fraudulent non-disclosure. Is that correct?
Yes, of course.
What is fraudulent non-disclosure?
All right. Thank you very much. I was actually citing an instance, and I was trying to paint a scenario that is enough to provide enough understanding, understanding or clarity on what it means. So I was talking about the man that intentionally took his insurance policy away from company A because after he had a series of claims in the first 3 years, the insurance company decided to increase the premium. The implication is that, the amount you have been contributing to this pool is not equitable to the amount of risk you are bringing to the pool. So you are going to increase your premium to bring it to the level where it will be equitable. So when he hears that, because he doesn't want to pay additional premium, he decides to take a policy, for example, motor policy from company A to company B. Company B gives him a proposal form to complete. He completes the proposal form. There is a provision in the proposal form that has this vehicle been insured before another company before? It says no. There is still another provision that says, if yes, confirm if there have been any claim lodged on this particular or about this particular vehicle in the past. It says no.
Wow.
So you can see that is intentional about this act of fraud, so to speak. So he decided to hold back that information because if he had divulged or disclosed it, the insurance company would have now asked additional questions and probably given him higher rates, ask him to pay more. So when there is a loss, if the insurance company in the course of their investigation finds out that this particular individual was intentional about telling lies, that is an act that we call fraudulent non-disclosure. It withheld information that could have assisted the insurance company to determine the equitability of the premium he was paying on that policy.
So do we have other types of non-disclosures?
Okay, so there is innocent non-disclosure.
Oh, we have that as well?
Yes, of course, we do. These are non-disclosures that are unintentional, and they do not have any impact on the risk or on the underwriter's ability to assess the equitability of the premium payable on the risk. For example, what is the model of your car? Toyota Camry, that's fine. Which year? 2005.
Right.
Whereas it is 2006 or 2004.
Oh.
So if it turns out that, yes, this guy, actually it's a 2005 and it said 2004, the question would be, what impact would that have made on the premium? Most likely that is not going to affect the premium payable. So that can be considered as innocent non-disclosure.
Okay, so and that will not really have much effect, right?
It will not. It will not.
All right, some questions coming in for you. This one says, good evening, Traffic Radio. Why do life insurance policies have different premium structures? based on age and health. You didn't put your name, by the way. But are there reasons why that is so?
Okay, so when you say life, the older you become, the likelihood that your health degenerates as the older you are, and then the likelihood of dying
is going to be high.
So these are some of the things that are taken into account.
Insurance companies consider
before they know the time.
This one says, "Good evening, Victor and Shadrach. Why?" Let me just get that. It says, "Why do insurers sometimes deny claims, and what are the common reasons for this?" Chioma is sending this one in from Arikbo.
Okay, so that is one of the reasons why we are having this conversation. We wanted people to know the principles that guide the operations of an insurance company, so that you will not be caught off guard if you have an insurance policy. What is most important is that when you collect your insurance policy, it is important that you go through it to see everything, what is expected of you and what is not expected of you, so that if there is a loss, it will not be at the point of claim that they will now be telling you, didn't you read your policy? We had set it and we told you that this is not covered, this is not covered. If you see something that is not covered, you can ask question, why are you saying this is not covered? I paid premium. They can now say, oh, the premium you paid is for X, but what you are asking for is Y. So if you want this, maybe you are going to make additional premium, additional premium.
All right, this one says, good topic, Victor. Out of curiosity, how do insurers calculate the premiums for different types of insurance policies? Olayemi is sending that one in.
Okay, so one of the things they take into account is the nature of the risk is important. The sum insured is also important. For example, a risk of flood in Lekki is more likely than it is here in Ikeja.
Oh.
So the underwriter will take all of that into account in his assessment of the risk.
All right. There's so many questions that are popping in for you, but we don't really have time. This one says, how does the principle of subrogation work in insurance claims? Another one here says, Mr. Shadrach, how does the concept of proximate cause affect insurance claims? All right, so we've not touched on those ones. Oh, this is Wumi. We're going to be discussing that probably next week, because out of the 7, we've only been able to touch on 1. So we'll definitely move on to the others from next week. But as we round off the program this evening, Shadrach, what's your message to our listeners this evening?
All right, so I want to let everyone know that insurance companies are willing to live up to their responsibility. But we, as the insured or buyers of insurance, we should also make sure that we take our time to go through our policy document, ask questions where necessary, make sure we do things the way it should be done, so that when there is a loss, they are not telling you stories. Most of the times, those stories are genuine.
All right, then we'll leave it there for now. It's nice having you in the building. Thank you so much for being here.
It's my pleasure.
Okay, so we started that conversation once again. We're looking at basic principles guiding the practice of insurance, and we wanted to understand reasons why insurers do what they do. Akan Hussein has put all of this together in terms of production expertise. I say a big thank you to you. Also, maximum thanks to Definite Media Concept for putting all of this together. Next Thursday, 6:30, the program makes a return. But till then, I'm Victor Oteri. Have a splendid evening. Bye.